You need to watch this video if you want to stop losing trades pointlessly. I'm going to teach you about closures, why they're important, and how you can actually use them to validate trades, avoid losses, and make big wins. So let's not waste any time. We'll get straight into it now. So first things first, what is a closure? Well, if we're looking at a 1 hour chart here, let's imagine these candles are hourly candles. That means every hour that passes, a candle will form. And at the end of the hour and the start of the new hour, the candle will close. So for example, this would be our closure. This would take place at the start of a new hour. This would be the open price of the next candle. At the end of that hour, once again, we get a closure, and this continues. We get a closure and open at the start of each hour. So a candle closure is just where the candle is when the new candle opens. In this instance, the closure is here. The closure is then there, 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 and then all the way up there, okay? Now, the reason we need to wait for these closures is because until a candle closes, it can reverse on itself. Now, if we take a look at this instance, we're in an uptrend in this example. The market's uptrending, we formed a high. The market then came down, formed a higher low. Now the market's pushing up to form this potential higher high. If the market was able to close over this swing high, that would open doors to continued uptrending movements, meaning we could continue buying this market because we know it's going up because it's continuing to make new higher highs. But if the market does not close above, and instead the market does this and pulls back down before that hourly candle closes, if it closed down here, then this would actually be a rejection of the high. Because when we're looking at candles, we have the bodies and we have the wicks. The body is this large block area. The wick are these sticks that we get on top or below candles. Wicks show attempted prices within a given time frame. So in this instance, this wick shows us that the market attempted to go this high, but it actually got rejected and the closure ended up being here. Now this means that the only confirmed price action within this price range is between this low, the open price, and this high, the closure price. Anything above that was just attempted price, also known as rejected price. So this is rejected price action, and then this is confirmed price action, just here. Now, what does this show? Well, this shows the confirmation has actually confirmed lower than the previous swing high, and the only push above that we had was a wick, which was rejected. So this market attempted to push higher but failed to close above, which actually rejects entirely the concept of seeing closures and continuations above this level, and instead suggests that maybe we could move even lower, because we haven't closed above the high, so we've rejected a new high, maybe indicating that we could be ready to turn into a downtrend. Now, if you saw this candle while it was open and it's moving up and down, and you decide to buy this candle before it closes because you think that it's closing above the swing high, well, if the candle then pushes all the way back down here, you've bought on unconfirmed price action. You've actually bought into a rejection of higher prices, which means the likelihood of your trade working out and not instead doing this is now considerably lower, and it's likely this trade could reverse on you. So if you bought up here during this push up, you had your stop loss here, well then it's very possible the market could even sink and stop you out of your trade without actually playing off at all. If you wait for the next hourly candle to open, so you wait for a closure and the next hourly candle opens like this, for example, well, now you have that confirmation. So the likelihood of us continuing even higher is actually now pretty much set in stone and a lot more likely because the market has proven to us that it's ready to make new highs. So that's why we need to wait for closures. Because if we don't get a closure and instead we get a wick, well then it's likely that the market will flip on us, or at least the probability of the market flipping on us is a lot stronger than it would have previously been, which means you can get caught up buying against movements like this that could instead actually lead us into a new downtrend. So following on from that, if the swing high was rejected, telling us not to get into a buy trade, and then the market moved lower and pushed past the previous swing low, well, this could potentially open the doors to trading the other way, which could completely flip our bias. And if we were aware of this and we waited for confirmations, we'd be able to take advantage of this new bearish price action. But what could also happen is actually we go and reject the low as well. So taking a look down here, let's say we pushed down initially, we formulated some bearish price action, but then before the candle closed, we had a push back up like this, and then we closed as a bullish candle once again. Well, now we are seeing the same thing again. We're seeing a rejection of this swing low. This is basically showing an area where sellers were pushing the market down, but at some point down here, buyers took massive control of this market and ended up running it back up to close at this point. If following on from this point, we then had a bullish candle that managed to go up and close above that previous swing high, so we'd be looking around this point here, well, this would then validate the buys. Finally, okay? Because what we've actually shown is an attempt to go higher that failed, then we had an attempt to go lower, which massively failed, followed by an attempt to go higher, which succeeded with this closure. And if this candle was to close up here, then we could continue with our bullish ideas, potentially looking to buy on pullbacks to take this market higher. So really, we have to wait for closures because you've seen just how dynamic this market has been. And in this example I've just showed you, how you could have been tricked twice if you hadn't waited for candles to close. First, at this top point up here when the market rejected the high, and second, when the market rejected this low. Now, obviously, this can be a big back and forth, which can be hard to get your head around. But really, it can all be solved by just waiting for the candle closures like this that we see here. Because if we wait for a closure above or below a swing point, then we have the confirmation we need to understand whether a market is building strength in one way or the other in a meaningful manner. So whichever time frame you're looking at, whether it's the 1 hour or the 4 hour or the 1 day or the 1 minute, it really doesn't matter. You just need to always wait for those candle closures to occur. When you get a closure like this above or below a swing point, you are ready to go with your trades. But if you get rejections like this one and this one here, then you should just wait out of the market until the market tells you to make a move. Let's take a look at an example of this then. This is a market that we've started to see pushing up in some bullish price action. Okay, we're getting some higher highs and higher lows forming from an internal structure perspective. Now, if we zoom out, we can see that overall, this is a downtrending market, right? So the larger picture is bearish, and then this smaller picture is bullish, where we're currently getting these higher highs and higher lows. Now, we can see what we've got here is pretty much a little swing high. So what we could expect to see would be if the market was able to close above this high, that could potentially lead us into some new uptrending moves, right? So from supply and demand perspective, let's say we wanted to look at possibly buying from this area if the market is able to close above the high that it is currently trading at. So if we were to close where we are, we may anticipate that the market could pull back towards demand and then continue buying. This could be the indication that maybe the market is starting to shift because we'll have seen that this high here is actually now being broken. So that point just there could be seeing a change in the trend, right? We could be starting to see these buyers take control. Now, this is then the point where we want to make sure we are getting closures above this level, right? Above this swing high. If the market is able to close above, that will give us what we need in terms of confirmation to continue trading higher. But if the market fails to close above, then we could instead be potentially about to see continuations lower in this market because it will show us that the swing high has been rejected. So a rejection would be no closure, and then a confirmation would be closure above. This would leave us with two scenarios. Well, the first scenario would be if we get the rejection, we would start instead looking for a sell. So a rejection would potentially open doors to sells. If the market is able to close and give us the confirmation, that would give us what we need in order to focus on a buy, right? So confirmation above, meaning if we just ended the hour exactly where we are now, that would be confirmation for us to buy this market. If we reject and we close beneath, well, then that would be a rejection. That's not a confirmation. That's not a closure. The closure's failed. And we've actually just seen rejected price action up there, which means instead we could look for a sell. Okay, so let's take a look at how this plays out then. If we allow this candle to close and the next one to open, we see that we've actually closed with a rejection here, right? So we got that rejection scenario that we're talking about. This is the point where the candle closed and a new one opened. The next candle has been slightly bullish so far with some rejections, but nothing is really locked in just yet. We need to see how this market is going to move. Now here we've seen a little push down in the market, so we're starting to see a kind of rejection that we might want to see. And now we've seen a little push under the previous structural low. Now that we've started to see this market closing a little bit lower, we could potentially be opening the doors here to take those shorts that we wanted to see. Now, obviously, we're looking to see if there's going to be significant rejection again, because remember, if we saw significant rejections, we could actually just see the market go and close back above this high and continue, which is why we always want to make sure we're looking at closures. Now, because this area failed to close, we can pretty much eliminate that demand zone. And instead, realistically, targets-wise, we would be looking at taking this market back down towards some previous swing lows, right? We've seen a failure to trade higher, which means therefore we could potentially see opportunity to trade lower, okay? So watching this market, we've seen some closures beneath. Just here, we saw a closure under this level initially. We've then seen the market push down. We'd now be looking to see if we can, again, close beneath that level. And as we have here, we would now be looking at opportunities to sell this market if we were able to pull back. So for example, the setup we could look at would be something like this. We could sell there. We could have stops above the zone, and targets wise, we could trade this down into one of those areas of supply, right? So allowing this market to play out, you see there, we got the pullback, tap into supply. Now the market is pushing down, tackling those swing lows. So that's a good thing. That's what we want to see. Now we've seen as well, there has been a closure under this first level. And now that we've approached this second level, what do we get? We got a closure. So let's just zoom in on that real quick. You can see just down here, the level of which we took profits on that first trade, we have a closure. What does this tell us? Well, this tells us we can go lower. If we'd have rejected this level with a wick and pushed back up, that would be grounds to potentially trade it back the other way, right? We would be saying, okay, maybe the market is not ready to close beneath. Maybe we're seeing rejection. So therefore we could potentially see this market return to the highs. But because we've had this closure just here, we could now anticipate that any pullbacks would provide us with pretty much selling opportunities once again. Now for this, what I'm going to do is drop down to a 30-minute time frame, see if we have any refined areas which are unretested. We've got this supply at the top. Now, if you want to watch a video on supply and demand, click the card at the top of the video just now. I'll also put a link in the description. But at this point, we have supply zone, which could potentially be traded into. We have closures telling us this market is going lower. The reason I would use this for entry is due to something called imbalance. Again, there will be a lesson in the description. And because we have the closures, we're now looking for continued downside. So if the market's able to pull back, we could look for a sell. This sell could continue down. For this trade, let's just keep it simple and look at this open demand zone below. So our trade would look something a little bit like this. That would be the position that we could look to take. And that would provide us with opportunity to trade this market lower now that we've had closures. So let's see how this goes. If we run it through, we got closure, second closure, which is good. We have a wick here, but the market did already close beneath. So that is a good sign. It's pretty much what we want to see to confirm the downside. If we have closure, then wick, don't worry about that wick too much because the closures have already happened, right? Then we traded back to supply. We hit the supply zone. We got triggered into the position at this point here. As of right now, the trade is still going. We haven't swept this high, which is where our stop loss would be. And then you can see that the market has made a big drive to the downside to fill that target, continuing the downside price action as confirmed by the candle closures we got here. We had the closures initially under this level, opening the doors to shorts. Then we had the closures underneath this level, opening the doors to continued shorts once the market pulled back. I want to bring attention, however, to this area here. Because here on the 30-minute, we can see the market did actually close, right? This level here was closed above on the 30-minute. So although the hourly rejected, couldn't we get tricked into the market from here? Well, what I want to talk about is time frame relevance. Now, you remember we set this trade up. We did our initial setup analysis on the 1 hour time frame, right? So the hourly was the initial time frame. Now we are operating on the 30-minute time frame, following on from what we saw on the hourly. We're using that 30-minute, if you remember, simply to get the more refined supply zones or areas to get into trades from, such as what we've covered here. But the setup premise was built on the hourly. So let's go to the hourly. You'll see the swing high that we initially looked at didn't close above, right? We had rejections up there, bringing the market back down and truly opening those doors to that continued downside that we've seen. The hourly being the most important time frame because this is where our setup came from. Take a look down here where we saw those closures previously. These still occurred. These were confirmed on the 1 hour time frame, which is our setup premise time frame, our main time frame. As well as this closure here that we saw underneath this structure. This is also clear and visible on the hourly. There is no rejection. So when I talk about time frame relevance, I just say when you find a setup, use that time frame to confirm that setup, right? This hourly setup was idea to buy if we closed above, sell if we closed below. So we want to make sure that we're looking at hourly closures or rejections. This here again was an hourly premise setup. It was a potential buy if we close above, sell if we close below on the hourly time frame. So although the 30-minute did actually close below as well, we used the 30-minute to find the refined area, We only trust the setup because the hourly, the actual setup premise time frame, closed beneath that level where we wanted it to close, all right? So make sure you're keeping things time frame relevant. If you're seeing an hourly swing point and a 5-minute candle rejects, don't worry about that too much because you might get another 5-minute candle that ends up closing the hourly bullish. But if you see an area like this where the hourly failed to close above, but a lower time frame did close above, trust the higher time frame because that is where you found your setup. That is what's going to be most accurate. Now, if you want to learn how to build this into a trading system, I have a free course called 7 Steps to Profitable Trades, which is going to teach you exactly how to build, validate, and test a trading strategy so that you can become a profitable trader with the information I've taught you today. Hit the top link in the description to check that out.